In this video, we'll talk about the basis of accounting, especially how to identify debit and credit side of a business transaction. So we'll start with the accounting equation. So for any business, we can say that the economic resources is equal to the claim against the resources. And the economic resources are nothing but the assets of the business. And claims can be of two types, that is owner's own claim, like we call it equity, and the creditor's claim, that is the liability for the business. So we can write that asset equals to liability plus equity, where liability is your creditor's claim and equity is your owner's claim. The equity can be written as capital, share capital, shareholders capital, and plus your earnings for in the business minus the expenses that you have incurred, minus drawings, any withdrawal if business owners they make from the business, and the dividends that have been paid. So the whole equation, if we take the expense drawings and dividend in the left side, we can write in this way. And this is very important because anything in the left, if that goes up, we say that is a debit transaction. If it goes down, it's a credit transaction. Just the opposite in the right side for liabilities, capital, and revenue. If if this accounts goes up, that is a credit. If liability, capital, or revenue that goes down, that is a debit. And the easy way to remember that is, as I said, is a dealer, DEA. D stands for drawings and dividends. E is your expense and A is the asset. And the L here is the liability. E is equity or similar to capital, you can say. And R is the revenue. So it is a easy way to remember which will go up and down and debit and credit side of it. Also in the brackets, I have put in the some numbers. Normally the asset starts with 1, liabilities with 2, equity counts with 3, expenses are 5, and earnings or revenues are 4. So let's talk about example now. We have learned it. Now I think we should be able to do it. Let's start with the first one. So we have a company, toy company. The first transaction is Sam invested $50,000 in cash in exchange of 5,000 shares. So what are the accounts here, right? It's cash and it is the share capital. It's easy. First, identify the different types of account involved in the business transaction. Now we have to understand what are the natures of that account. Cash is an asset, share capital is equity. There is no liability involved here. Now, 50,000 cash invested for your business, so cash goes up. And if you can see from this diagram, the basis, if asset goes up, it's a debit. So cash goes debit, and share capital, it also goes up because he received 5,000 shares, and capital is in the right side. So if it goes up, it's a credit. So cash to share capital, $50,000. Easy, right? Now also you have to we'll do a T account here. The same thing has been put in here, nothing special. Cash left side is debit, so 50,000 will sit in the left side. Share capital as a credit, it will sit in the right side. So this is the detailed balances of your particular accounts. So when we'll see the ledger, we'll see why it is important. Second transaction, Sam bought office supplies for 2,000. Here, what are the accounts? Office supplies and cash, and both are of asset. There is no liability, no equity, right? And again, from this small picture here, we know if asset, office supplies is an asset, it goes up. We have more assets, more supplies, it's a debit. Cash is reduced. We paid cash for the supplies, and cash is decreased. So this is a credit here in this left side. So office supplies to cash 2,000. Now in the T account, you can see 2,000 is sitting in the right side of the cash account, and this is the credit side of it. Paid rent for December. It's not a prepayment rent. It is you stayed for the month and then you pay the rent. So there are two different things, and you have to be very careful about it. So this rent paid is a rent expense, and this expense is here, as you can see in the left side, and that is an equity account. So paid rent, it goes up, it will be a debit, and you pay in cash, so cash goes credit. So that is here, and you can see there is one more entry in the cash in the credit side is $200. Example transaction number 4. This is interesting. So he bought a computer of $600, but he paid $100 only, and $500 he took it as a credit for 5 months installment. So what are the transactions? What are the accounts involved here? One is the computer, which is, you can say, it's like office supplies. Fine. The other one is this $100 cash he down paid, and the third one is that $500 credit. It is not paid yet. So we have three things involved. So what is the asset account? Anything asset here? Yes, it is office supplies and your cash. Any liability? Yes, you have a credit. So it is a payables account that you have to pay for it, or credited account, you can say, and there is no liability. So the transaction here is going to be your cash is going down. So it is a credit now because you paid $100. Creditor account is going up, it's accumulated. So now you have $500 payable. You have to pay $500, right? So it was zero, now it is 500. So it goes up. So that is a credit side because liabilities goes up is credit here. You can see this diagram. And the supplies is again, it is goes up. You purchase some computer, new computer, yeah, it is a debit because it goes up. And this is your T account now. Okay, so example transaction number 5 is you sold something to a customer in $100, but you haven't received the payment yet. So here it is a dated account. It is accounts receivables because you invoiced and haven't received the payment. If you have received the payment, it would have been a cash. So now the accounts involved here are the account receivables or debtor, and as you sold something, this is your sell or earning or revenue. So we have asset as your debtor and equity as your revenue. Now is asset is going up, meaning account receivable is going up, so it is a debit. You are accumulating more debtors, and revenue is also going up because you sold something, and this is credit here. So this is my accounting, and this is the T account structure now. I'm not going into the detail of transaction number 6. We can have a look that you have collected cash from a customer, but you haven't provided the service yet. So it is unearned revenue because you have a prepayment from a customer, but you are liable to pay him the service. So this is how it is. This is my last transaction here, and this is where you have paid your creditor balance for supplies. So initially we had $500 as a credit balance for the payables. Now you have settling of that payment. So you are reducing the payable balance. So when you reduce a liability, that is a debit. And yeah, you're paying by cash, and cash is also reducing, so that is also credit. So here it is, and these are final T accounts. Nice. Now journals. What is a journal? That is a chronological record of transaction entered by business. So you have done 7 journals so far, so this is nothing new to you. You already have done it. Only thing is missing was this values like date and the reference number and a brief explanation of the transaction. Everything else was there, and the reference is when you post the journal to Ledger, you get a reference. You can think like a primary key or some IDs that will come here and say it's a posting reference for the journal. So that's it. This is how the journal looks like. And posting is exactly transferring the information to ledger. It's called posting in accounting. And how the ledger is look like? This is your ledger. This ledger contains the group of accounts for business, all the accounts. And it will also show the detail of individual debit and credit side of the values. Now you can see the cash, especially where you have a balance, a debit balance, which is good. We have a debit balance sitting for your business from these transactions, which have been posted in ledger from different journals. And you have seen these T accounts before. Now, once we have the ledger prepared, where you have all the accounts, we have to tally the debit and credit side of it. And this is called the trial balance. It is the list of all ledger accounts, and it is used for devising the equality between the debit and credit side of it. And you cannot go to sleep until you match this debit and credit side of it. So this is our trial balance from our toy company based on the values that you have received in the ledger. Thank you for watching. Hope you are confident in understanding the basis of accounting, and seeing a transaction you can find out, identify which is the debit and the credit side of the transaction.